Good afternoon, everyone, and welcome to today's webinar, Risk Management Planning and Grain Marketing Strategies for 2016. Just a quick comment. First of all the attendees are in listen-only mode, but you can type questions into the control panel on your screen in the question box. We'll kind of collect those, and we're going to leave some time at the end of the presentation to ask our presenters those questions as you have them. So my name is Tom Cosgrove. I'm the Senior Vice President for Public Affairs and Knowledge Exchange here at Farm Credit East. Today's webinar is being brought to you by Crop Growers LLP and Diversified Crop Insurance. I should mention that Farm Credit East is one of the partners in Crop Growers, along with Ag Choice and Yankee Farm Credit. And after I introduce our presenters from Diversified, Jeremy Ferret from Crop Growers is going to make a few introductory comments. So from Diversified, we're pleased to be joined by Rich Morrison and Doug Emery. Rich is from Illinois and went to the University of Illinois and really has been in the grain business his whole life. He joined Diversified in 2001 and is a licensed Series 3 commodity broker and crop insurance agent. He works with producers across the country providing market information through some of the tools that are being shown on your screen. So welcome, Rich. Also from Diversified, we have Doug Emery. His roots are in Indiana, so not surprisingly is a graduate of Purdue. So we have two gentlemen from Big Ten country with us today. Doug spent 18 years in the ag lending industry, many years in the farm credit system. So we're glad to welcome a farm credit alumnus to today's session. Doug's been with Diversified since 1999, pursuing his passion of working with producers to help them understand their risk. And so before I turn it over to them, I'd like to welcome Jeremy Ferret from Crop Growers for a few introductory comments. And Jeremy, we appreciate your assistance in setting up today's webinar.
Absolutely. Thank you, Tom. First of all, I'd like to welcome everyone to today's webinar and thank you for taking time out of your day. One of the key reasons that we found this webinar so important is over the last several years with the grain markets and volatility in the grain markets, we understand that there have been some successful producers that have made their way through this volatility, and there's been many other producers that have struggled during this time. So some of the keys that we recognize from the Crop Growers team and agents that we have in the field is what are those keys that contribute to success during this volatility. And one of those key points is understanding grain markets, understanding what influences those markets, understanding where the highs and lows are and how to capture the highs and avoid the lows. The other component there is feeling comfortable with grain marketing, forward contracting. We understand that there's many producers out there that really haven't been comfortable forward contracting a crop prior to harvest. And we recognize that those folks may find themselves considered price takers rather than price makers. So the other component that our team has recognized is those that have developed a crop insurance risk management plan using a revenue policy, which Doug will talk about later on. We found that that group has a stronger sense of risk management and the ability to weather this storm, weather the volatility, take advantage of opportunities when they present themselves. So that's the purpose for today's webinar. Just a quick comment on our relationship and gratitude to Diversified Crop Insurance Services for joining us today. Is we recognize that they were the leaders in the understanding of grain markets, the understanding and developing those crop insurance risk management plans that really pull all those key components together and in the end can help our grain producers and Northeast grain producers be successful during this volatile time. So looking forward to the discussion and at the end open conversation, questions, and with that I'll turn it over to Rich Morrison. Rich, great to have you with us, and looking forward to your insight into the coming year.
Well, thank you very much for having us. Appreciate the introduction. What I would tell you about our background as a crop insurance company is that we do come from the grain business. Our parent company is a grain company, Consolidated Grain and Barge, and so that's always influenced our direction of the way we looked at crop insurance and the way we looked at grain marketing. And so that kind of precedes what we do. We were an independent agency for a long time. We got into the crop insurance business, and now we're probably the fastest growing crop insurance company, and I think a lot of that is because we do work with producers on the marketing side. And that's been basically my role, is to provide market information daily, as well as throughout the year in travels and meetings and things like that. So I want to spend a few minutes kind of describing the situation going into 2016 and kind of my thoughts on the markets. This data from USDA, pretty well known, but certainly paints the picture for where we're at here at the end of 2015, with net farm income down, expected to be down 38% this year, and at the lowest level since 2012. And so it's really put a lot more focus on risk management. How we can preserve equity, I guess, is probably a buzzword this coming year, but certainly it's at the forefront of people's minds. A couple of reasons we are where we are. We had some record high prices back in 2008, 2011, 12, and those record high prices really encouraged big acreage expansion here in the U.S. and around the world. And we've seen the green chart, or the green bar on this chart, shows that we, from 2007 to 2014, increased about 13 million acres of corn, soybean, and wheat production here in the U.S. The same when you throw in sorghum and cotton. Now, last year we dipped on acreage a little bit. A lot of that was because of prevent plant ground. It wasn't because of people idling acres. This year we're expecting to see some of those acres, majority of those acres, come back into production once again. And the big reason we saw the big acreage, or where the acres came from, it came out of grass. CRP acres are down 12.7 million, hay down 3.8 million acres during this 8 or 9 year period. So we haven't taken prices low enough yet to discourage this ground from getting planted to something. And so as it stands right now, it looks like we're going to have big acres again in 2016, which can keep prices in check. The other big reason is yields. We've had an unprecedented time, I think, in the world as far as world yields go. Since the drought in the U.S. in 2012, just about every major producing country has had 1 or more years of record production. So you couple big acres with big yields and kind of sets the tone for where we're at going into 2016. Looking at the markets right now, these have been the issues that I see dominating the markets. 2015 has really been dominated by a strong U.S. dollar. That's at the forefront of the conversation again here this morning. The talk yesterday about the interest rate bump, that was, I guess, viewed as kind of an exciting thing for the economy here in the U.S. Made people feel good, and we were seeing a rally in the dollar once again. The dollar, this is as of last night, but the dollar's up over a full point here this morning, and that's keeping pressure in the grain markets. But the dollar last week traded to the strongest level since 2003, and with this big rally in the dollar over the last year and a half, it has really made U.S. grains less competitive in the world, even with lower prices, and we're struggling on the export side. This chart really shows that the dollar in orange versus corn in blue and soybeans in red, how over the last, this goes back to 2005, but when we've had strong periods in the dollar, we've had weak periods in grain prices. Conversely, here in 2008, when the dollar went down, we had strong grain prices. Happened again in 2011, and now we're seeing the flip side of that with the strong dollar and weaker grain prices. Even with big production, you would hope, and with lower grain prices, you would hope we'd be stimulating new export business, but it just hasn't happened quick enough. We've chased a lot of the investment money out of the ag markets. I think the strong dollar tends to do that. They don't view that as a good investment when we're having trouble competing in the world markets, so we've chased a lot of the, we call them spec funds or managed funds, away from the ag markets. Commodities tend to, are in a tailspin right now with that strong dollar. This chart here shows the corn market going back to January of this past year, and the dark green line on this chart represents the weekly position of the spec funds in the corn market. The gold line is the corresponding nearby futures price. And each Friday afternoon, we get an updated commitment of traders report from CFTC. So this shows their weekly position. Right now, they're short about 60,000 contracts of corn. They started the year long nearly 250,000. Sold a lot of that off into the early part of spring. Part of that was because of a stronger dollar trade. Part of that was because we were planning to plant big acreage. A couple of things happened in June to trigger this big round of buying. We saw the dollar weaken for a short period of time, and we saw some problems getting some of the crops planted. And so with that happening simultaneously, saw these spec funds go from 150,000 contracts short to over 250,000 contracts long. So they bought 400,000 contracts of corn in just a little over 30 days. That's 2 billion bushels of corn. That's bigger than our carryout is estimated to be this year. That was responsible for a 75-cent move in the corn market. So as these folks buy, it certainly carries a big stick in the markets. But since about the middle of July, they've turned sellers again and are now on the short side of the market. I think going forward, I think that can be construed as a positive thing, because if they're already short, maybe if we give them a reason, they'll step back in and buy. If we were to see the dollar start to weaken, maybe see a weather issue in the southern hemisphere, whatever the case is, might see them back in the market. So I view this as at least not negative that the funds are short at the present time. Soybeans, pretty similar situation. They're still short about 10,000 contracts as of last Friday. They've spent a lot of time on the short side of the market this year, most of that because of the world fundamentals that we're seeing. Wheat, have been very short for a long period of time here in wheat. We've had big world stocks building over the last 3 years, and that's really caused them to trade wheat from the short side of the market. But again, I think this leaves them susceptible to some buying if we give them a reason to. So I think that's a reason to be optimistic going into 2016. The last reason, or the last issue, just dominant world crops, large U.S. world crops. I mentioned an unprecedented run in production, and that continues to kind of hang over us. Looking at the corn market specifically, we've had very stiff competition in the export market. A lot of that is driven by that strong U.S. dollar. Our export commitments to date, the black line showing the lowest we've been except for 2012, which was the drought year, and we had record high prices at that time. So, you know, that really puts it into perspective that we're just having a hard time competing at the world level. And despite good feed demand, ethanol demand continues to be very strong for corn, but on the export side, we're down 114 million bushels from last year projected, and down 167 million from 2 years ago, which has helped to maintain a very high stock level at almost 1.8 billion bushels. Someone did point out earlier this week that it's a far cry from the 4 billion we had back in the 80s, but nonetheless, we're very, very comfortable right now, especially given that we're expecting more acres to get planted in 2016. Informa Commodities, they put their numbers out here last month. They're going to come out with a new acreage estimate later today, but they're estimating next year's acreage at 90.1 million, up 1.7 million from this past year. USDA's baseline projection that was out last week was at 90.5 million, and Farm Futures Magazine's estimate was 89.7. So everybody's looking for more acres next year. We do anticipate demand will probably improve, but even with that, we're figuring stocks are going to be in the 1.5 to 2 billion bushel range next year. Now, Farm Futures is using a lower production estimate next year, maybe assuming some weather issues. So nonetheless, we're expecting prices maybe to be in the $3.50 to $4 range again through 2016. I am a little bit optimistic that we'll see some rallies at points in time, so we want to be ready to take advantage of those. The weekly chart, you know, shows over the last year we've traded majority of our time between $3.50 and $4 corn. And so if you were a speculator, you could buy $3.50 and sell $4 and do quite well. I really think from a producer standpoint with old crop corn, I'm really looking in the $3.80 to $3.90 range to be a seller. I think if you get down in the $3.60 area, maybe you consider buying call options or re-owning it on paper that way. But I'm not expecting any big moves. I think this purple line, the 100-week moving average, is going to be very tough resistance going forward, and that's at about 395 right now. So I don't expect it will challenge that, barring any big production issues. So I'm really looking at that 380, 385, 390 area to sell old crop corn. For new crop, we were looking pretty good until just this week. Yesterday, the market sold off pretty hard with the rally in the dollar, and we're seeing some more of that continue here this morning. We're trading another 3 or 4 cents lower. Last year's crop insurance price was at $4.15. I'm willing to be very patient on corn at this point. I think we've got some Questions still, on the acreage going into next year. That's not set in stone yet. We've got some weather issues potentially down the road. My targets on new crop would be this blue line, the 200-day moving average at about 406, and then the 420 high we had back in October, and I would probably fade that by a nickel, maybe look at the 415 area or so to really get serious with making some hedges for next year. And that's where I think it's prudent for producers that know how to hedge, have a hedge account, be able to use that to be able to place a hedge, give yourself a lot of flexibility in your marketing, and but be able to lock in some prices. And if it's and that happens to coincide with last year's crop insurance price, so I think that would be an excellent opportunity to get a good start for next year. Soybeans, we continue to see the world supplies outpace demand. About 3.5 years ago, we recognized with prices where they were that we needed to grow soybean acreage, needed to grow supply to catch up with demand. We've been able to do that. The U.S. has had record yields 3 straight years. Brazil looking at potentially its 4th straight record crop, and Argentina, even though down slightly from last year, still a big crop. So it's been, like I said, an unprecedented run in production, and we finally found a way to get supply to exceed demand, looking at world record stocks this coming year. Export inspections beginning to be a bright spot. The Chinese were slow buying U.S. beans at the beginning of the year. They were buying a lot of beans out of South America. Most of that was due to the currency differentials we've had because of the strong dollar, but they have been aggressive here as of late, so we at least are catching up a little bit on the export side. But overall, USDA still thinks we're going to be a little bit light to last year, maybe over 100 million bushels less than last year, and consequently ending stocks could reach their 2nd highest year ever, 465 million bushels. I really think this export number is going to be a little higher when it's all said and done. I think the ending stock number could be a little lower, but we could still exceed 400 million bushels, which is a big number here for U.S. stocks. Couple that with record world stocks, just a real bearish scenario here for beans. So for corn, I think you could maintain somewhat of a sideways trade through 2016. Soybeans, I still think, have some more softness ahead next year. Looking ahead at acres, Informa, they're projecting 85.3 million acres, up 2.1 million. Farm Futures is up 3.1 million with their estimate. I think USDA is too low with their guess for next year, but most of the estimates in for stocks would be upwards of 500 million bushels next year. So still maintain a bit of a bearish tone with beans going into next year, so we want to be fairly aggressive selling when we get an opportunity. We're kind of hoping that the weather in the southern hemisphere might give us that opportunity. There are some issues right now in parts of Brazil and Argentina. Northern Brazil is very dry. You can see by the vegetative health map here that Mato Grosso and some of the other states there are very dry and not expected to get rain here going forward. Consequently, or adversely to that, conversely, we've got southern Brazil, Argentina that have been very wet here in recent days. And it's basically like late June down there right now, so not a period where you want excessive water. This latest forecast map shows that southern Brazil, Uruguay, eastern Argentina, Paraguay, all expected to be very wet over the next 2 weeks. Not so much rain in the upper part of Brazil. So it's been a real hit and miss situation. I had seen one forecaster calling for locally 10 to 20 inch rains in parts of southern Brazil over the next couple of weeks. So the verdict is still out on the crops down there, and we're kind of hopeful that we'll get a chance to see a little bit of a weather bump. But it doesn't look like it wants to happen here ahead of the holidays, so I'm kind of thinking maybe when we get into January we'll put a little more focus on the South American crop. Looking ahead to their weather forecast, Jan, Feb, March, temperature-wise, expecting to be hot in the north, cool in the south, and dry in the north and moist in the south. So it looks like that trend is going to continue. And right now the forecast for Brazil to get 100 million bushel bean production, I would tend to think that's a little bit uneasy at the present time. Possibly could be the high for the year, and maybe we'll start to see some projections start to work a little bit lower from those numbers going forward. So soybeans, we're just barely off the contract lows right now on cash spot beans. So the market is not taking South American weather into account yet. I want to be pretty aggressive with old crop beans. If we get any kind of a rally, maybe if we get back to this blue line, the 21-week moving average at 896, or up here to this chart gap where the gold line is. 933 is the bottom of that gap. I don't think I'd have a bean left if we got back up to that level. And part of that because we're still going to have a big crop in the south, part of it because of big stocks, and part of it because of big acres expected here in the U.S. next year. November futures, we're well below last year's base price for insurance at $9.73. Now we're about $1 below that level. Again, given more acres expected, I'm looking at these moving averages around the 890 level is pretty tough resistance if we're able to get back higher. Above that, I'm really looking at this blue line, the 200-day moving average at about 918. I think I would be very aggressive, maybe get up to a third to a half sold for next year if we're able to get back to that level. And maybe we'll get some weather scare in the southern hemisphere to help us do that. Wheat, we've had world records now 3 straight years on production, where production has exceeded demand. The black line above the pink line, that's helped build stocks for 3 straight years in the world. And as typically happens, the U.S. tends to be the residual supplier of wheat. There's too many other suppliers closer to end users, and consequently the U.S. ends up building stocks, as we've done here this year. Export sales well below the 5-year average and well below last year. Looking at ending stocks, USDA projecting this year at 911 million tons. That's the highest in many years. Next year, even with 1 million or so less acres, Informa's projecting ending stocks to actually rise just a little bit here on wheat. So kind of hard to paint a friendly picture here on wheat. I would tend to think sideways to lower probably our pattern going forward, and that's really the way we spent most of 2015, just kind of fading the market lower. We failed a couple of different times at the 100-week moving average. Even the gold line, the 50-week moving average, hasn't been able to hold for very long. Maybe we get back and test that again if a person has old crop wheat to sell. Looking at the new crop, last year our crop insurance prices were set back here in August and September, right around the $5 mark, give or take. That would be the first hurdle to look at for marketing, but the one thing I would mention with wheat is that we have the PLC program for many folks. If you have wheat base and elected PLC, that's price loss coverage, and the trigger for that is $5.50 on a national average market year average price. So as long as we remain below $5.50, if you've got your wheat base in the PLC program, there's really not a lot of incentive to jump out and forward sell much wheat. So I think wheat selling is going to be pretty quiet, whereas for corn and soybeans, if a lot of folks are in the ARC program, which I think they are, we don't have that price protection, so we do need to sell the rallies there. But with wheat, I think it's a little bit different, given the fact that the majority of acres, especially in the east, went to the PLC program. Will El Nino be the answer? A lot of folks talking about El Nino. This article in AgWeb last month mentioned $7 corn next year if El Nino switches to La Nina and we get the typical dry weather situation in the western corn belt. Now, the next day after that, there was a guy wrote an article talking about $1.70 corn next year. So I figured out that the way to get published is to predict an anomaly on price. But aside from that, there is a lot of focus on next year. What's happening with the change from El Nino to La Nina? The red on this was ENSO's forecast from early December. They're expecting El Nino to kind of stick around but start to weaken getting into spring, and then see that transition to La Nina happen sometime, maybe summer, maybe fall. Now, the latest forecast really still shows neutral conditions kind of weighing out in June, July, August, September, but maybe starting to see that transition to a La Nina pattern. Typical strong La Nina pattern in the growing season would mean usually a heat dome in the southwest and drier conditions in the southern plains, maybe even into the western corn belt. Typical strong La Nina years, we don't see very good crops in the west. So those of us in the east wouldn't be the worst thing in the world, but that's certainly something that the market may watch here as we flip into 2016. These are some of the latest forecast maps on out into the spring. For January, looking for a general warm to the north, cold to the south, drier to the north, maybe a little wet down in the south. Looking ahead to spring, Feb, March, April, again, similar pattern, warm and dry to the north, cool and wet to the south, going into spring. And then they put out these July maps yesterday, which kind of started to indicate maybe a heat dome over much of the country as we get out into the summer months. maybe a little more moisture to the east, maybe a little drier back to the west. So as of this time, nobody's really forecasting a La Nina type crop situation, but this heat forecast for the middle of the summer might cause some worry here when we start to talk more about 2016 here next year. The farm program, good news, it may add some dollars to people's pockets this year. The latest estimates are 2015 to be the high year as far as program payments. The biggest chunk of that is the ARC program, and what generally is good for the ARC program is that we've had some high prices over the last 5 years. ARC uses a 5-year Olympic average price, so we throw out the high and the low of the last 5 and average the other 3. Now, unfortunately, as we go forward to 16, 17, and 18, we'll see those 5-year Olympic averages start to drop pretty sharply because we start to lose some of the high price years we had back in 11 and 12 and 13. So as that happens, our triggers for the county ARC program are going to drop, and so will our potential for payment dollars. But for this year, looks like we've got some decent payment potential in many areas. For PLC, which is just price only, the crops highlighted in pink would have prices low enough to trigger PLC payments. The PLC, or those final marketing year prices, won't be determined until the end of August, so we got a ways to go yet, but as of right now, we'd have quite a few crops that would be triggering a PLC payment for next year. For the ARC program, we're looking at the market year averages, currently at $3.65 for corn, $8.90 for beans, $5 for wheat. I mentioned for PLC on wheat, we're 50 cents under the PLC reference price, so that's why we don't have to be very aggressive marketing wheat. For ARC, especially for corn and soybeans, we're going to compare this price here, the market year average, times the county yield, and then look back and compare that to the 5-year Olympic average price times 86% times the 5-year Olympic average yield for the county. So because of the drop in the price, counties can even have an average yield this year and still see some fairly large ARC dollars paid. Even in some areas, yields may be better than the 5-year average and still pay some money for the ARC program. So we'll be watching that going forward. USDA or NASS usually starts to release county information the first part of March, and then we'll track that against the current market year average price to determine whether or not there might be some payment dollars. If there are payment dollars made, they're not made until the end of October because we don't have the final prices till the end of August. So from a cash flow standpoint, it's hard to count this 15 ARC or PLC in with the 15 year. Most of that money will come during the 16 marketing year. As far as potential payments for the ARC County, given USDA's current price projections, FarmDoc projects corn payments for ARC be just slightly lower on average than last year. But again, these will be all over the board. Some counties will see large payments. Some counties may not see payments where yields were very good. Oats, soybeans, wheat, all expected to see some average ARC payments here for 2015. We do have a calculator that we can plug in a county yield span, a price span, and then be able to determine whether or not and how much that ARC payment might be. So it's a very good tool to be able to use when we're trying to project potential payments for next year. Lastly, I kind of want to finish up talking about managing price risk. This is data that USDA put out here a couple of months back showing when the crop gets sold. This is corn, and they're showing from 2007 to 2014, and they show that the majority of the corn crop gets sold in the October through January window. We don't sell a whole lot of corn from March forward, usually 5 to 10% of the crop by month. Here's the 10-year monthly average of December corn futures from 2006 to 2015. Generally shows us that the highs get made during the summer months, so producers probably ought to be leaning towards marketing a little heavier out into the summer months than they have been. But I think that's partly because maybe we got burnt a couple of different times with some of the drought years, and people are a little bit leery of selling out ahead of time. But historically, that would make us some money. Soybeans, even more so, focused on the fall through winter period, 30% of the crop sometimes sold in the month of October. But historically, the highs get made in June, July, August period on November futures. So again, we probably as producers need to be focusing more on marketing during the growing season. We do have a product called Price Select I wanted to introduce. This year, it's the second year of the product, but the first year that we've been able to include the summer months. The way Price Select works, it's an add-on tool to your crop insurance policy. Crop insurance currently allows you to use February and October to set your prices. The higher of is what you use to determine your guarantee. This product allows you to choose other months besides just February and October. Where we really look at it, the biggest reason would be as if we were to get a summer rally, and like we've seen in some recent years. We have the product available this year for corn, soybeans, and cotton. You can purchase Jan, March, April, May, June, July, or any combination of those months that you wish to add to the February and October prices. It's available in New York this year and Ohio. That's about as close to the Northeast as we have, but for many of the folks on the call, that would encompass the state of New York. So we do have it available this year there. We look to expand it next year. We have a 60-cent limit upside on corn, a $1.20 limit on soybeans. The sales closing dates are 3 days prior to the beginning of the month for January and March. For April through July, March 15th, our normal crop insurance sales closing date would be our final day to purchase this, or if the state happens to hit its limits. We have limits in all of our states that could be well hit before March 15th. Again, looking back at the history, history shows us that the summertime we typically see better pricing than what we would see in February or October, so this product allows you to be able to do that. Historically, when I look at which months would have triggered in which years, June would have triggered 3 times. July would have triggered 4 different times. May, April would have triggered 4 times. And what that means by triggering, it means that we would have then recalculated your guarantee using that higher price. It doesn't necessarily mean that there would have been a payment because we still had to have a revenue loss, but this would allow you to get more dollars guaranteed. And especially in a year like this where we're starting out, in most cases I would think we're going to be below cost of production on our insurance guarantees. This may allow us to get up there. Also, if you're looking to forward market in the summer months, then having the backing of the Price Select product, having your crop insurance recalculate its guarantee at that time if we get a rally, would work very well with forward selling. So this is where I really think it has a benefit. It helps a producer maybe to be able to pull the trigger knowing that their crop insurance revenue guarantee is going to be recalculated at that same time. Soybeans, we showed this a second ago. We tend to make our highs June, July, August. When we look at the history, 5 out of the last 10 years, June would have recalculated or refigured a guarantee. July would have done it in 4 years. May 3, other months 2 or 3 years. So I'm really looking at that June and July period as a positive this year. We just got our quoter turned on for this product yesterday. I can tell you that it's very inexpensive, just a few pennies a bushel to be able to add it for both the June and July period. So something to consider for 2016. My final points for this year, I think number 1 is that producers need to move away from the I need cash now marketing programs. It worked well when we had record high prices, maybe not so well now that we've got big stocks and limited rallies. 2 of the tools that I think we need to understand and utilize more are basis contracts, taking advantage of strong basis when the futures are not strong, and vice versa, being able to separate that portion of the bid. And then the other side of that is option-based contracts. Producers can sell grain and buy call options or call option spreads to replace that ownership. We've talked a lot through this growing season about using 3-way put option spreads to where you buy a put option, sell a put option maybe 40 or 50 cents under that price, and then sell an out-of-the-money call option. Oftentimes you can get that done for 0 to a couple of pennies, but it does allow you to be able to protect the downside window of maybe 30 to 40 cents. Those are tremendous tools to use around crop reports, and we've had, I think, 3 negative crop reports this fall. Those 3 ways would have been a great option trade used ahead of those reports. Consider some of the untraditional crop insurance tools. The Price Select program we've got for corn and soybeans. We've got supplemental coverage option available for wheat. That was part of the new Farm Bill last year. Those are some of the tools that we can add additional coverage. Lastly, encourage producers to market some of your crop insurance bushel guarantee. You may not sell the whole guarantee, but we certainly, there's numerous reasons you buy a crop insurance policy. Number 1 is it helps you sleep better at night. Number 2, helps you to get financing. But you're buying bushels that are guaranteed no matter what happens. So take some of those bushels, market when the market gives you an opportunity to lock in a profit. That's probably the biggest takeaway. going into 2016. I think we can do a better job of that, and hopefully we'll be on our toes and be ready to do that next year. That's all I've got this morning. I appreciate the opportunity to visit, and I'll turn it back over to the hosts.
Great, thanks, Rich. So while we're getting Doug set up for his presentation, I'm just going to remind folks that if you have questions, you can type them into the question box in the control panel portion of your screen. And then I think at this point, and then Rich, we'll look forward to, if you could stick around, we have some questions for you later on. We'll mute you for now, and then we're going to turn it over to Doug.
All righty, thank you. I just want to visit here today a little bit about making informed management decisions. In regards to 2016, as we talked to Rich, obviously the concern is tight margins, and when we get into that situation, I think we got to get back to the fundamentals of risk management, and by far and away the most important thing you can know is know your costs. And when you're looking at knowing your costs, you've got to be honest with yourself and look at all the different scenarios you might be able to adjust to for the coming year. Have a profit goal. Having a profit goal and having a plan allows you later in the season, if you get a rally, to make a more competent decision. So like I said, know your cost, have a profit goal, lock in the profit whenever available, and certainly understand government programs. We have developed a tool. Initially it was developed to help train our crop insurance people on visiting with farmers, and it's blown into a lot larger use today simply because it's such a impactful tool. It allows you to understand potential consequences of management decisions, whether it be input cost, the impact of the variability in yields, grain marketing decisions, all those types of things. So here's a quick look at it when you are operating on the internet. This is the whole program as you see it. I'm going to break it down here just a little bit. Here you've got a section here that shows where you put your costs in. You can show 1 acre or you can show total acres. I've got this set up today to show just 1 acre. Put in all your fertilizer, chemical costs, seed costs. Now on the custom harvest or harvest rates line, what I've done is I usually lump sum all the other fuel, repairs, all those other items in here, but the main thing is to come up with total costs at the bottom. Now we're using $550 an acre for 135 bushel corn. That might be a little conservative, but there again, you got to know your own cost. Another section here is set up to put in your historic yield. What's been my average yield for the last 10 years in my farm? Here we're using 135 bushel. Down below here, as you look at it, there's a spot here to put in the type of insurance policy, whether you use an enterprise, optional, or basic units, coverage level. You can also come in here as it shows and put in your government program situation. Section here, you put in the local basis level up in the top right-hand corner, put in D's futures. You've got a section there if you forward sold grain, put those bushels in at what average price. You've got the ability to put in some minimum price contracts, those types of things. So once you have the basic information for your operation put in, and as you're here, we're focusing on the grid at the 100% of APH at 135, which is right up here, then you would come over to the right and put in, okay, what's been my best yield? What's the most optimistic I can be for the coming year? And clear over to the left, I'm using 50% of average as my worst case scenario. Once you get those plugged in, then we would come down through here, come back down here and put in what I think the low price for the year at the lower left, top right, what I think is probably the most likely price for the coming year. We're using $3 to $5.50. So what you've got here is if I'm going to raise an average yield of 135 bushel, and I come in here at my current price of, let's say, $4.20, that would suggest yield times price minus expenses, I would be making approximately $17 an acre. Now the more important thing here is, once you put these things into the profit matrix, is to look at the spread. Now, if you go from bottom left to top right, you're looking at about $700 of risk. Now, usually I don't go to the extreme corners, but what you're seeing here is if you slide back in a little bit, you're probably looking at somewhere around $500 an acre of total financial risk on an acre of corn for 2016. For those who have been farming for a while, you could go back 10 years ago, and 10 years ago, $500 an acre was probably more than you were grossing. So it just underscores the fact that there's a lot more risk in farming today. You can also set this up to show you return on investment. So where am I at relative to my cost per acre? Now then, once you have the basic in, we can come in and start making management decisions. What if I picked a 70% revenue protection policy with optional units? We're going to say that's going to cost roughly $13 an acre in New York this year, for example. So when we come over here again to average yield and price now, that would show you that from $17 profitability down to $4, simply because at that price yield, your crop insurance policy would not have a claim. Now down here in the bottom left, I didn't point this out maybe very good. Let me slide back here. When we first started down in the bottom left, you were up over $300, a lot of $250, $280 an acre loss categories. So what happens here is by buying a 70% policy and spending roughly $13 an acre or whatever it'll be at the time, you can see we've taken probably $200, $150 of risk out of your operation. So what this tool is doing is allowing you to visualize the impact of making that decision. What if I spent $13 on this type of policy? How does that affect my bottom line? What would happen if I took an 80% policy and I switched from optional units to enterprise units to keep the price down? Obviously, talking to your agent, you'd want to understand that impact. What is the difference in optional units versus enterprise units? But it does allow you to get higher coverage at a lower cost. So in this scenario, by making that change, we can see that our safety net jumps up higher. We're pulling another $50, $60 an acre off of the loss potential in your farming operation. What would happen if I knew that year in and year out, if I raised an average crop of 135 bushel, I always have to sell 50 bushel an acre because I don't have the storage capacity. So in that scenario, if I had an 80% policy and I decided that I would be comfortable selling at 435, how does that impact my bottom line? And here again, you can see that as price goes down, we have put a higher safety net in under your operation. Now, granted, as you go up in the top left, if we see a rally, you're not going to participate on that rally on those 50 bushels forward sold. What would happen if I jumped to an 85% policy and spent, say, $22 or more an acre and reached out and got a little more aggressive and sold 75 bushel an acre? What this just allows you to do is look and say, okay, does this make sense for my operation? Am I comfortable with doing that? Now, one thing I want to point out here is in this grid, there are 128 boxes. Each box is a different price yield category. And down in the bottom left, I've got one circled there in orange, and you would say, and most farmers would be panicking now because I sold 75 bushel an acre, and at this level, 50% level, I didn't even raise 75. I only raised 67.5 bushel. Now, how can I be making money when I raise less than I sold? And the way this profit matrix is set up is I can click on any one of those 128 boxes and it will pick up the math behind the profit matrix and it'll take you through. Okay, I had 135 bushel, 85%, I've got 115 bushel guaranteed approximately, 75 sold at 435, I'd have $326 of expected revenue. Subtract my expenses, I'm still looking at a substantial loss of about 43%. Excuse me. However, I still have 60 bushel to sell. If I sell them at the fall price, say 313 at this price level, you know, I'm looking in at that level, looking at about a 10% negative return. With my 67 bushels of corn actually raised, as you can see under down here, that I've got 8 bushel that I've got to go to the elevator and get out of that contract, and it's going to cost me revenue of, in this scenario, of about $23 or $4 an acre. We come over to the top right, we look at our insurance policy. We got a $476 guarantee in the spring. Prices fall, my guarantee in the fall is lower. I always get the higher of the two with revenue protection. I take my 67 bushel raise times the average of D's corn in October, which in this case is $293, gives me actual farm revenue for crop insurance purposes. I subtract that from my guarantee. My claim's $278. So if I take my $326 that I was expecting from contracted grain, subtract away the money I had to pay back to the elevator because I didn't have those bushels, add back in my crop insurance policy. In this scenario, I'm showing no government payments. I end up with $581, which actually is about a $9 per acre profit, or a 1.7% return. So this is set up to show you the math behind every situation. Here again, what are the consequences? Where will I end up at the end of the year based on the decisions I'm making today? Okay, now we talked a little bit about a profit goal, and what I want to do is go back to last year, and this is another part of the profit matrix. And what happens here is it takes your expected yield and it goes out. It's an internet-based program, so it goes out each day and gets the close of D's corn for 2016, or the harvest month coming up, and adds or subtract basis level, multiplies it by 135, and subtracts expenses. So a year ago at this time, early January, when you were looking at your situation, and if the yields and costs and everything that we have in here related to you, then last year you were looking at somewhere of break even to approximately maybe a $10, $15, $20 an acre profitability over into about March. Once we got to March and April, then prices obviously started to go down because planting season went quite well. And as Rich mentioned a little bit ago, and you can see it in some of his charts in terms of the funds jumping in, we had that big rain event especially, and what you had there was close to a dollar rally in June into July. Now as you look at this chart, that price rally took you from close to a negative $50 an acre profitability up to just a little over $50 a profit. So in your farm operation, if this was yours, in that short time frame, you went from losing 40 to 50 bucks an acre up to potentially making $50 an acre on corn sold at that, say, 441 level. Now then, when that happened, everybody was caught up, emotional, extremely emotional, and having a plan, having a goal, and knowing that at 425 or whatever level I was going to sell some because I could lock it in. Then you can make a better decision when you're dealing with emotional packed time. So this is just another part of the profit matrix. Now as you go forward in 2016, all you're going to see is up to the date chart. You're not knowing what's coming forward yet. Another thing here, we show you the last 21 years of corn price, and what this does is the zero line shows you the average price of D's corn in February, and it compares then to the average price of D's corn in October. And as you can see here, 2/3 of the time, historically, price of corn is lower in October than it is February. And you can see here that we've only had one time or 3 years in a row where price was higher in fall, and you can attribute that to the ethanol boom in 2009 and 10, and also the drought of 12. But historically, being aggressive selling corn 2/3 of the time, you're right. So we're just looking at playing the odds and understanding historically what has happened, and then also putting together a risk management strategy that you can also react to a strong price rally. Here's a very informative slide. I don't have it going on back, but I think you would see this same thing repeat. But what you got here is basically a 30 or 35-year cycle. And if we went back into the 70s, you'd see this big price rally in the 73, 4, and 5, where you have a huge amount of price variability. But once you get through that 3 or 4 or 5 years, then it settles back into a pattern of a lot less price variability. And basically, in my opinion, what you've got to do is this period of 2008 through 12, 13, you got to put that behind you, because what we're rolling into, in my opinion, probably will be a more narrow variability in price if we follow what has happened historically. If you look back at 80 through 2007, we basically hovered between $2 and $4. Going forward, if I was putting together a farm management risk management plan, I would be probably looking at $3 to $5 is where we're headed. But and there again, my opinion. But here again, forget the big, huge variabilities in price during the year. Be prepared for a lot tighter price range as we go forward, unless we get into obviously a substantial weather deal. The way we train our agents and the ones that work with us is it's our job to assist a farmer in understanding their true financial risk, help our customers make informed decisions, and when you have tighter margins, sometimes I think it's a better decision to raise your crop insurance coverage, raise that safety net up. At this point in time, what management decisions should I be making to put myself in a comfortable position so I can sleep if there's problems come during the 2016 growing year? Obviously, no one knows what it will bring, but putting together a plan, visualizing and understanding the consequences of decisions made. That's the one thing. I've got 4 kids. I always told them, I said, I don't care what decision you make, every decision will have a consequence. So what we try to do with the profit matrix and some of our other tools is to provide you the ability to kind of look forward in your operation and say, okay, is this a sound management decision? And that's what I want to challenge you today is, start looking at what decisions should I be making for laying the foundation to a profitable 2016. I wish everyone a very profitable and joyous 2016 and a happy holidays. And back to the host.
Great. Thank you, Doug. Again, just a reminder, if you have some questions, you can type them in here. I also want to remind all the participants that we are going to be posting a recording of the webinar at farmcrediteast.com/webinars, as well as we'll be posting PDFs of the presenter slides. So for questions, I'm going to actually turn it over here to Jeremy to lead us through the question and answer.
Great. Thanks, Tom. Doug and Rich, obviously a timely topic with a lot of great takeaways and insight as we enter 2016. A question I'll start off with and then see as they come in here, but what advice do you guys have for a grain producer that's not familiar with forward contracting? We see the volatility. We see that the summer months bring us opportunity. We can talk about the risk that's associated with volatility, but it also creates opportunity. And one of our messages as we work with producers is feeling comfortable and confident in using the full benefit of your crop insurance policy to take advantage of those opportunities. What advice would you have to help those producers take that step in forward contracting? And I'll open it up to both you guys.
I guess my thought on that is the easiest way to learn it is to do it. Now I know we've had that experience with folks on options before, where we've tried to host some different kinds of option trades over the years, where people that had never traded an option before just got their feet wet by opening an account and buying one put, for instance, in the summertime. So I think that's the easiest way, is just to get your feet wet and have some faith and jump in and then track it, know what you're doing, or you see what you're doing, take it to market every week, figure out how it's working out for you. But I think that's the biggest thing. And there's some classes, I know junior colleges and things like that offer support programs and things like that as well. But certainly I think the only way you're going to learn is the best way is just to get in and do it.
You've got to find a trusted advisor. You've got somebody in the area or somewhere that you trust and who is very education oriented, who will walk you through it and teach you and get you comfortable and make sure you understand the decisions that you're making and how they'll impact you. So you just got to jump in, but at the same time get good, reliable coaching.
There you go, and thanks, guys. That's kind of the feedback that we provide producers: is establish a relationship with a merchandiser, identify a price that can be a profit point, and once you're tracking that market and you hit that price, it's go time, and feel comfortable with a small percentage. That's our philosophy there as well. So appreciate that. We have another question that we've got here. And Rich, I think you've covered this well, but I think it's good to hit this again. Where do you see the opportunity for producers as we look towards 2016? So question here is, where do you see the opportunity? You commented that corn's looking to be flat, with soybeans looking to have some downturn. Any more thoughts, or can you go a little deeper in 2016 potential opportunities there? Good point.
Well, I think that the obvious here to start the year will be South American weather. That may not directly impact our crop production side of things, but it could impact the demand side for the U.S. So that'll be the first thing we're watching. I think the currency market, we've had about a 1.5-year run to the upside on the dollar. We'll see if that can turn. I know we've got an election next year, so there are some things like that can have an impact on currencies, and that might be something that would add, that would give us a little bit of a boost. Acreage next year, we're expecting an increase in acres, but who knows? We're not there yet. We don't have them in the ground yet, so got a ways to go there as well. But certainly with as much stuff that's going on around the world right now that is affecting currency markets, with crude oil being very volatile, I would have to think we're going to get some opportunities. We had some opportunities this past year. They weren't a lot, but we did get some little bumps there in the summertime, and we've just got to be on our toes and ready to take advantage of them. And kind of like we said, it's about equity preservation this year more so than trying to lock in a big profit. But I think we just got to be ready to act.
Rich, and I'll go. Oh, sorry, Doug. Go right ahead.
Yeah, historically, the market has always given us at least one opportunity. There's no way to know what's going to bring it, but you've got to be comfortable that when it comes, to pull the trigger.
And thanks, Doug. And Rich, I'll actually tag on to this comment that we had here in question. Through your service, you have daily market calls. So for that producer that's busy, it's planting season, they may be working on another crop during some opportunity months. You have a service that at 11 o'clock every morning, voicemails, phone calls, giving a market update. You want to just talk about that for a moment?
Yes, we have a few different things that we provide at no cost. We do the market call at 11 a.m. every morning. It's about a 2-minute call, gives everybody an update on what the markets are doing that morning, why they're doing what they're doing. If you don't answer it, it can go to your voicemail and you can listen to it later, or you can dial the number back and listen to it. So it's always going to be there. So that's one of the things. We've got about 5,000 farmers that are on that call right now. It's growing all the time. We do an email letter every afternoon. As long as I'm not traveling too much, try to get a letter out every night with an update on what the markets are doing and why. Occasionally we'll put in there some market strategies, say some option type strategies, things like that we want to look at. So that's a different method of trying to get information out. The third Thursday of every month, which happened to be earlier this morning, we do a webinar called the Third Thursday Marketing Meeting. And so we talk about all the crops and give some ideas on marketing there, as well as crop insurance and the farm program and things like that. We send out a monthly newsletter that I write the day of the crop report each month. So that's another means of getting information. So we've got quite a few different tools that we use to try to provide information. The great deal about them is the cost is pretty good. They're free. So we want our insurance to do a good job making money and utilizing that policy.
Thanks, Rich. And you know, that's one of the value added items that our relationship brings to our marketplace. So we really appreciate that. We've got one last question here as we're up on the 1 hour mark. And a question is, what portion, so as producers are evaluating their grain marketing strategy, I'm interpreting this here, so making sure I put it in context. Doug, I'm going to direct this one to you. As producers are putting their grain marketing strategy together, what could, with a crop insurance policy, so they've got a revenue policy, they're looking at forward contracting and putting together a strategy, what would you see as that strategy throughout the growing season? So prior to planting, once the crop is in the ground, and prior to harvest. And Rich, maybe you can add some color here as well, but putting together a marketing strategy using maximizing your revenue plan, how do you see that play out, and what percentages of a crop, or how would you approach that?
I don't know if there's any set plan. What you've got to do is always be reacting to what the market is giving you. So, you know, with the, you know, I'm a big fan of the profit matrix, so I'm always looking in it to see, okay, where am I at in my operation? Am I at a profitable level? And setting goals. So if the market's giving me a profit, I've got to look at that and say, okay, is that a level that I'm going to be comfortable with? And if I'm comfortable with it at 10% of my crop, or 25%, or half my crop, then pull the trigger. Now, I will say, the more aggressive you get at forward marketing, you have to be pretty savvy at doing some of the option trades or hedging and things, because as you saw in that one price chart, you know, 4 years out of 21, there was a substantial rally because of probably mostly weather, or like we said, ethanol. So if you've been an aggressive marketer that year, you probably want to have something in there to protect the upside. So the more aggressive you get, the more savvy you have to be in understanding your tools and options available to you in the market.
I guess my personal preference, I've always been willing to sell half of my crop ahead of time. I always figured that people you feel comfortable that you could grow 50% of a crop in most years. Anything more than 50%, then I would probably want to do with options. But I don't feel uncomfortable about selling half. Now, in some of the years where you can lock in a profit, I would be more aggressive early in the year. Years like this where you can't, maybe, I'd probably want to have some targets in place, like Doug said, know where your cost of production is, and then look at the charts and see, you know, if some targets make sense, and have those offers in so that just in case they hit. But so each year is going to be a little different, but I've always felt 50% was a number I felt comfortable with.
Rich made a comment there of watching the charts. The simplest thing you've got to understand in charts is simply pay attention to the market in terms of is it in an uptrend, or is it trending lower? And if it's trending up, then I can be cautiously selective about when I pull the trigger. But my experience has been, when that market's in a downtrend, you can't sell it fast enough. So if we get into a little bit of an uptrend, sell into it. But if the trend turns just like last summer, and you can see how fast it went away, you've got to be willing to be aggressive if you're looking to lock in some profits that are there on the table.
Great. Thank you, guys. A lot of insight, and that was our last question. One item that I'd really like to share with all the producers on the call as we enter 2016, covered a lot of valuable information here. As Tom mentioned, this is going to be a recorded session, so you can go back to it and see if you had some questions or missed. But one of the things for producers as we enter the winter months, which is in many cases considered the planting season, we ask you to reach out to our crop growers agents. Talk with them early. This is a powerful tool that Doug shared on the profit matrix. We could sit down, we can visit with you, understand your cost of production, and start to build a plan surrounding your crop insurance and your grain marketing plan. So encourage everybody to reach out to our crop growers folks. We're here certainly to be a part of your team, and we appreciate that opportunity. And with that, I'll turn it back over to Tom for final wrap-up.
No, thanks, Jeremy. Just wanted to thank Rich and Doug for joining us today. As you can see, our next webinar is going to be on the dairy outlook on January 15th, and as always, please check back at farmcrediteast.com/webinars where you can hear recordings of past webinars as well as register for upcoming webinars. So with that, again, Rich, Doug, thanks so much for joining us today. I'm going to wish everyone a happy holidays, and we will see you all in 2016.